Welcome to BusinessLine's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hey everyone, ahead of the Lok Sabha polls in the coming months, Finance Minister Nirmala Sitharaman will present an interim budget on February 1st, that is the upcoming Thursday. This, albeit a vote on account, will be her sixth consecutive budget speech, equaling a record with former Prime Minister Morarji Desai, and the last budget of the current union government. Expectations on the budget announcements are palpably high given the aspirations of 140 crore plus Indians who want all-round economic development besides inclusive and sustainable growth. Coming as it does at a time when India, as the world's fastest growing large economy, is poised to grow at 7% this fiscal and likely to maintain this tempo next fiscal too, all eyes are on Sitharaman to see how the centre would help maintain growth momentum in the economy. Analysts, investors, and economy watchers are also keen to know as to how the centre would find a right balance between fiscal consolidation and encouraging growth, putting more money in the hands of Indian middle class while sending a clear message to foreign investors reaffirming the country's reformist credentials. With just a day left for the D-Day, BusinessLine spoke to Upasana Bhardwaj, Chief Economist at Kotak Mahindra Bank, to gauge our perspectives and understand what may be in store for India from the interim budget. Through this interaction with Upasana, I hope to give you all listeners a flavor of the expectations from the interim budget, the likely direction and approach the government will take on various economic issues around budgeting, and the story behind those numbers. Here is a brief introduction of my guest today. Upasana Bhardwaj, Chief Economist at Kotak Mahindra Bank, heads the economic research for the bank. She has been part of the group since 2011. Upasana's expertise lies in analyzing domestic as well as global macroeconomic issues and their implications on the financial markets worldwide. She comes with a diverse background, having worked with ING Vysya Bank, ICICI Bank, and the Energy Research Institute. Prior to her research role, she had served as an economics lecturer at the Delhi University. Upasana holds MPhil and Master's degree in economics from the Delhi School of Economics. Welcome to the BL State of the Economy podcast, Upasana. We are now meeting at the beginning of a year and at quite an interesting time when there is all-round optimism on the growth prospects for the Indian economy. So let me straight away dive into the topic at hand, which is on the 7% growth trajectory that is being envisioned for the economy. My first question to you, Upasana, is this podcast happens on the heels of Finance Ministry's latest report, or should I call it a review report of the economy, where it talks of the country could aspire for a $7 trillion economy by 2030. I wanted your take on this and how realistic do you see this projection or this aspiration to be?
Over the last 6 to 7 years, I would say a lot of reformist measures, the remedial measures have been taken. And the economy, which was earlier ailing under a lot of weaknesses, we've emerged out of that. And now when the foundation is set and the stage is set, I think a 7% plus growth, a CAGR over the next 6 years is doable. And somewhere close to $7 trillion economy can be achieved by 2030.
So going by this growth rate that the economy is now clocking, you expect the 5 trillion mark to be reached by 26-27.
Yes.
Do you see the interim budget pressing the accelerator on the fiscal consolidation front, given that India is now included in the JP Morgan's Global Emerging Markets Index from June this year?
Absolutely. I think firstly, like you said, it's a vote on account or an interim budget. So, we should not really expect too much of aggressive announcements that the government can come about. And the finance minister has already indicated that we should not be expecting any major announcements. That is one thing to remember. But having said that, I think the broad pillars of growth, which we've witnessed even in the previous budgets as well, will continue to dominate the theme of the budget, even in the upcoming budget as well. So I think the key themes which the finance minister will again re-emphasize is that the infrastructure focus does remain intact. The rural development is going to be important with an emphasis somewhere on gender equality. I think somewhere the female-male income ratios and all will be crucial, and we'll see probably some minor measures which could come about attempting to bring in some kind of equality there. I think there will be enough focus on clean energy, renewables, and that is something which I believe will continue not just in this coming budget, but in the subsequent budgets for the years to come. Ease of doing business, further push to make in India, and like you mentioned, most importantly, their commitment to fiscal consolidation. They would definitely go ahead with announcing and showing their intention to adhere to a severe consolidation path. And I'll just mention one thing here. What is important to keep in mind is after the inclusion announcement of India's bonds, government bond in the global bond index, it has become much more important to become fiscally prudent. It gives India less headroom to be relaxed on that front, given that now foreign investors will be viewing the fiscal parameters much more closely, especially because if we were to compare India's whole macro fundamentals, the whole macro matrix, then apart from the fiscal side, every other matrix is a shining star. It's only the debt to GDP ratios or the fiscal deficits of the country which are a little on the weak spot. So I think this is one thing which I do believe that government will adhere to, and we are looking at a reasonable roadmap which will be set, which they've in fact already announced that they will be achieving 4.5% in the next 2 years. So they will have to announce accordingly 5.3 or 5.4% fiscal deficit for the coming year, and then another 100 basis almost consolidation in the subsequent year. There is no way, where they can really not do something like that.
Sure. So my one point of, I'm just curious, right? Without the bond inclusion announcement, anyway, market observers and analysts were predicting a glide path which will take our fiscal deficit from 5.9 to 5.4, right?
Right.
So do you at all see a further stretch to send a strong signal to the international investor community? Do you think there will be an attempt to go down up to 5.2 or 5.3, as you said? Will there be an extra effort, or this is par for the course? Anyway, we were expecting 5.4, right?
Absolutely. See, ideally, if they were to achieve 4.5% by FY26, then the 150 basis of a consolidation in 2 years has to be evenly distributed. Otherwise, it becomes unreal, right? So clearly, they should move towards a 75 to 80 basis of a consolidation in 1 year in order to achieve in the 2 years consolidation part that they have set. So ideally 5.2, 5.3 should have been a right number to announce so that they can really show their intention of achieving a 4.5% next, the subsequent year. But having said that, honestly, I think a 0.5% is a more realistic consolidation that can happen. And that's the reason I believe 5.4 or maybe 5.3 best case they can stick to. Especially, I want to highlight one thing. The reason being, last year's tax buoyancy was FY24's tax buoyancy has been very high. And we do not expect the tax buoyancy of that level to continue into next year. And hence, somewhere expenditure cuts and expenditure pruning is going to be much more important. We believe that fiscal consolidation, much of it is going to be arrived by, a much lower growth on capital expenditure, unlike the previous years. In fact, since the pandemic, we have seen that the government has really stuck to a very high growth on capital expenditure. We believe that that is going to be toned down to just a very low double-digit numbers, maybe between 10 to 15%, that kind of a growth, rather than having a 30% plus kind of a Y-on-Y growth that we were witnessing earlier. So I do believe that somewhere expenditure pruning is going to be much more important, especially in the backdrop of a lower tax buoyancy compared to last year. And hence, I'm saying that I'll find 5.2% much more difficult to be achieved, but I cannot rule that out. I definitely believe that 5.2 will set the intention very clear that they are going to be taking this up very seriously.
Now, the expectations are very high, especially among industry, that the juggernaut will continue and there is going to be a sizable bump up. So can you leave me with a number on what you expect the Capex projection for 24-25 is likely to be from, say, beyond 10 lakh crore, which we saw last year?
We are going with a 15% growth approximately. So I think around 11.2, 11.3 lakh crore is where we are going with. I think anything beyond that at this point looks difficult. Like I said, if fiscal consolidation, they have to stay the path, then they will have to cut down on capital expenditure growths, and up to 15% is where we're looking at. So 11.2, 11.3% lakh crore.
So given the last 3-year track record, that should lead me to a conclusion that there will be a slowdown in the Capex allocation, right?
Yes, the growth. There will be a higher level, higher number, but yes, the growth has to definitely slow down.
So two takeaways what you have shared is, one, you feel the next year's fiscal consolidation will primarily be expenditure-led, in the sense that cutting down on expenditure and at the same time reducing the allocation for Capex. Am I right there?
Yes, I would just like to add one more thing. I think there is a little bit room on subsidy allocations, a reduction on the subsidy funds side as well. Fertilizer subsidy particularly, not food, because food had its own stickiness attached to it. But we do see some room for lower budget for the fertilizer subsidy. So apart from Capex.
So that leads me to the big question of the podcast is, we are doing this in an election year, right? So how do you see the government looking at subsidies or the welfare measures allocation? It is normal logic to expect these allocations to go up in a budget year, right? In an election year, right? So how do you see them panning out?
One, on the subsidy side, I think they would be reducing the allocations, as I mentioned. On the food subsidy, I expect that to increase a little. But on the fertilizer subsidy side, I expect a fair amount of reduction, about 20-30,000 crore of a reduction. Meanwhile, on the rural development, the agricultural segment, I do expect some announcements to come. Like I mentioned somewhere about gender equality, somewhere the scheme under which the annual payouts to the farmers, so the female farmer category could be receiving much more funds, annual funds. So there could be some segregation happening. So I do expect a little better allocation under the rural development category, agriculture category. These are the two segments rather than subsidies.
Sure. So, in essence, you would not like to draw to a conclusion that the budget will be populist.
Yes, I think it's difficult in this at this point. Number one, because their commitment to fiscal consolidation is much more important at this point. Secondly, we should also keep in mind that there is a little bit of confidence post the state elections, and the need for going all over populist will be limited.
Got that. Yeah, that's a very interesting point. And therefore, how does the private investment story play out? What is your expectation? Because there are differing uh, schools of thought and stances, right? So, what is the true picture of private investments? Are they back or they are still work in progress?
I would say work in progress. Clearly over the last few years, the private capex cycle has been the missing link in India's growth story. Last decade, rather, I would say broadly. And it has been in the last few years, it's been mostly public sector investments. Now, I think, again, the foundations are laid, given that we have, banks are much better placed in terms of their balance sheets, in terms of having the ability to lend better. The corporate sector balance sheets are also better paired. They have been repaired. If you look at the NPA ratios of the banks, that is also very low now, minimal. Most of the corporates have deleveraged. So, we are not really worried on the asset quality side. So I think somewhere the foundations are laid. But having said that, maybe there are some more quarters to go before we can really see a clear broad-based pickup in private investment. I think right now what's really happening is it is very selective pickup that's happening. Whatever announcements that we're hearing or for going ahead, there are very selective in key infra-linked sectors. But my sense is a broad-based private investment cycle will pick up or not before 3 to 4 quarters.
Sure. So, how do you react to the finance ministry's stance, which says that private sector investments have started crowding in, and banks are now stepping up the credit disbursements to the private sector? Is that really playing out?
I think in the very early stages they are. So I would still say if I look at the bank credit to the large corporates, even for the medium corporates, actually medium-sized corporates, it's not really meaningful at this point. And we are not seeing too much of an offtake, loan offtake or a credit offtake happening for the industry sector as a whole. Much of the credit offtake that is happening is actually retail led. That is one thing to keep in mind. So clearly at this point, I would not say that the private capex, whatever increase in credit offtake that's happening, I would say has mostly been working capital led, not capex led.
Sure.
So for now, yes, it's work in progress. It's beginning. It's early signs of pickup that we are seeing, and that should begin incrementally contributing. So yes, the crowding in has started, but it's yet to pick up pace.
So, in your radar, when do you see actually an upturn in private investments? When do you see the animal spirits coming back?
Animal spirits, I would say, Srivas, it's still there. It's like optimism is there. And, we are looking at India really growing very well compared to the rest of the world. So, confidence is there. I think what is important is somewhere there is a state of flux between, how global growth will pan out post the most aggressive rate hikes that we've seen in recent history, because, that too has a bearing on private capex. Plus, at the same time, domestically, there is a lot of, uncertain mixed patch of data, which is suggesting that there's a little bit of saturation on urban demand and rural demand is a little mixed. So when we settle, I think when a little bit better clarity comes about on these global and domestic factors, let's say in the next 6 months or so, is where I think we start seeing the incremental pace of credit, of capex cycle picking up, private capex, that is.
Sure. So, do you see schemes like the PLI yielding bigger dividends for the economy?
Absolutely. Yeah, absolutely.
And has
I
it already started playing out? Because one does see some bump up in mobile manufacturing and areas like electronics.
absolutely. Yeah, I
But
think
what,
2, 3 sectors where we are seeing traction already is, like you said, electronics. The other is the solar panels and all. And the third is also the ACCs, the chemical cells, etc. So I think these are 3 sectors where we are already seeing a fair amount of traction. And all other sectors will slowly we'll start seeing the benefits arriving from that. I think PLI is a very good scheme. It will be benefiting the manufacturing sector significantly. Both it will be promoting the Make in India scheme for sure. At the same time, exports, which I think is important to keep in mind, that exports as a percentage of our GDP, it has been, in the last, let's say, where it was 8 to 10 years back, the share has come down. So I think this itself is going to reverse. So from a near 16-17% of GDP as exports in 2014 or so. Today, 10 years later, we are at around 13% or so. So I think this PLI scheme will help in again now reversing this trend, this downward trend.
even though the quantum has bumped up to $500-600 billion.
Absolutely. So I think what has happened is the CAGR of GDP has been much more than the CAGR of exports.
Exports.
So
Okay.
that's over the 10 years I'm talking about.
So that takes me to the next question. The elephant in the room is the Red Sea trouble.
Yes.
Do you see that getting aggravated, or do you see that impacting our overall export performance this fiscal?
I think this fiscal we may still sail through. We're left with 2 months of the year. We may not see as much of disruption happening. But clearly, geopolitics is something which has become a basic norm which we are living with now. This is now has become a base case which we have to live with for with every period that we are referring to. Now, Red Sea, clearly, if it sustains this issue, if it persists for too long, it will be impacting the exports. As of now, it is a price effect that's happening because, there's a rerouting of ships that is happening, and that clearly will make things expensive. So one is the price effect. Then the other is after a while, when the prices rise so much, that it starts impacting demand.
Because of the inflation.
Absolutely. So that's when the overall exports may take a hit if this problem was to persist for too long. So clearly, we'll have to be watchful on that. At the moment, I would say in the near term, I don't see too much of a risk because of that. But clearly, it will depend on the duration of the problem and the scale of the problem.
Sure. So that takes me to a very interesting question on, given the backdrop of this Red Sea issue, and also the fact that we are have to have a budget before us, what do you think is going to be an ideal nominal GDP growth that you will pencil in for next year? Are we going to see a lower projection than the 10% that we saw last year?
No. I think we should be looking at about somewhere in the range of 10.5 to 11%. We are at 10.8% for next year. So I think somewhere close to that will be where government will also, use it for their estimates.
You don't see that happening?
No, I don't see a sub 10% reading. I think it will be above 10% growth.
Yeah. Okay. So the last question is, are we going to see some surprises in terms of new scheme rollouts for the budget?
Srivats, I think, to expect too much from this interim budget is probably not right. It is not to say that schemes haven't been announced in the previous interim budgets. There have been some tweaks that have happened to the tax slabs and all in, I think, 2009 elections as well, interim budget as well. But I would say that the finance minister has kind of made it clear So they would probably refrain from very big bang announcements, but there will definitely be tweaks to certain existing schemes where they can, wherever there will be scope, they will try to enhance the allocations. And as I mentioned, I do expect a shift away from urban infrastructure to rural infrastructure. So there will be allocations accordingly. There will be further allocations under the rural schemes, welfare schemes. So those kind
So
of minor changes will happen.
do you see a bump up in, say, PM Kisan or Manrega?
PM Kisan, I think there's scope for it. Like I mentioned before as well, I think there could be higher allocation. From 6,000 rupees, it could go up to 8,000 or 10,000. But it may not necessarily happen across the board for all farmers. It may happen for female farmers only, or, so we might see a little nuanced changes that would happen to these schemes.
Sure. So my last question is on disinvestment, right? For the third or fourth year, we are going to have a situation where the government will miss the disinvestment target. I think this year they are going to probably not even reach half of the last year's B. So how do you think this gap is going to be made good on the non-tax revenues?
No, I think for this year, if you're referring to, then we've had very good tax buoyancy. Tax collections have been good. We've had a much higher than budgeted RBI dividend to the government. So that is going to be offsetting the loss from divestment. That is one. And of course, within expenditure, there will be scope for some kind of expenditure pruning as well, wherever required. So I think this year, we're not really looking at a slippage. 5.9% can be managed as per the budget numbers. So, we don't really see a risk to 5.9% being announced.
You don't see, as some commentators are saying, that it might even go to 6. You don't see that happening.
So I'll just mention here that 6% is technically, even with the same absolute fiscal deficit number, which was budgeted, we still will have a 6%, given that there is a downside that has come about because of a GDP revision compared to the budget numbers. So because of that, naturally, the 5.9 becomes 6% in terms of the ratio. But like I said, there are upsides that we are seeing in total receipts and some amount of expenditure pruning, which is possible. And that may result in a 5.9 still being achieved, because it is about 0.1%. So that 6% is more a technical shift happening because the GDP number has been revised down.
But for the record, you expect her to say that we are sticking to 5.9. Okay, got that. But coming back to disinvestment, right? 51,000 crore was the budgeted, and we were around 10 to 12,000 crores of actuals. So how do you see the government approaching this for the next fiscal? Do you see them lowering the next fiscal's BE, or just to reaffirm their commitment to privatization, they will stick to the same BE levels for next year also?
We have taken a much lower number for next year. Now, again, we are looking at 5.4% fiscal deficit for next year. And we believe that if realistically they put in a number for disinvestment around, say, 20,000, 25,000 crore or so, then that could be achievable. But yeah, again, if they put something like FY24's BE numbers of 61,000 crore, then clearly there will be a downside to that number, because typically, like you said, we do see slippages there. But having said that, if they give a higher number for disinvestment here, then the 5.4% of fiscal deficit can actually shift to a 5.2% easily, as I mentioned before. So the ability for them, it depends on whether they want to show aggressive fiscal consolidation. And if they do want to, then they may actually use a higher number. My sense is, instead of disinvestments, they would rather focus more on asset monetization scheme, which is parallelly happening. And hence, they should slowly reduce the allocations or receipts that they're expecting under the disinvestment here.
Okay, but net, you don't see a scaling down of the non-tax revenues?
Not much.
Okay. And final thought, oil. the crude oil number that they will use to pencil in the projections. Where do you think are they going to stand on that? Is there a number that you are looking at?
I think it should be around 80, 85. I think that is reasonable to go with the 80, 85 dollar a
So
barrel.
net, you expect the budget to be a sort of a continuation of the last 2 or 3 years in terms of the focus on capex, while keeping a tight lid on the fiscal deficit.
Absolutely.
Okay, great. Thank you, Upasana. Thank you for all your insights and thoughts. It was great talking to you for a BL State of the Economy podcast. Thank you so much.
My pleasure.